Hey, greetings. Thanks so much for joining us. Samantha LaDuc, founder of LaDucTrading.com with Craig Shapiro, our micro advisor edge manager. And we do this every once in a while, every 2 weeks, talk macro to micro, answer questions, live Q&A. And we do this every day for our clients, but we want to just kind of open it up and get a little lay of the land. We've had a lot of economic data today, which was really a make what you want of it. But I saw a lot of stagflation, meaning lots of higher and sticky prices, but also some weakening growth and sales, consumer spending figures. So I want to turn it over to you, Craig, and kind of run us down what we have seen. Also, massive treasury supply this month as we head into June, and FOMC, options expiration, and of course, QRA at the end. What's the data look like, and how's the market faring?
This short clip is presented by Edge. Edge is our pro-to-pro advisory service, which is all about the macro with a focus on one-to-one engagement with the hedge fund manager, Craig Shapiro, economics advisor, Jeffrey Fouvry, and direct access to LaDuc Trading founder, Samantha LaDuc. For more information about Edge, visit www.laductrading.com/edge.
Came into the week, it was it's been a holiday shortened week, so kind of had to plow in a lot of data and a lot of treasury supply in a short period of time. And I think folks went home into Memorial Day last week. The ball was kind of at the lows, market was at the high, complacency, very elevated, move index kind of broke down to made new lows. And I think there was, just a view that nothing was gonna stop this freight train kind of after, I guess, the NVIDIA numbers, towards the end of last week. And look, a Fed that is not desirous of raising rates to slow down inflation. And so further, so if the market is thinking, well, look, then that means we could kind of run assets hot and the Fed's not going to do anything about it. So that was kind of the view, I think, ending the week and coming into this week. And look, things, not that they change quickly, but, narratives shift, quite rapidly. And so I think what we have seen so far this week, just kind of, kicking off with the treasury supply, this is something that is known, but it's large. And it's every other week in size, duration issuance on, massive government deficits for, as far as the eye can see. And these are not the type of flows that can very easily be front run. And so, look, when Yellen has to sell 220 or so billion dollars of twos, fives, and sevens, it's a lot. And it just takes the market time and price to digest that increase in supply. And so I think what we had this week was the bond market sell off on back of that supply and on back of an economy that still is fine. Growth is starting to slow, but not in a very meaningful or accelerating pace. And inflation is staying sticky. And so, the Fed's really not going to be doing much. We also had some foreign bond weakness, particularly in Japan, and then later, yesterday in Europe. And so I think that exacerbated some of the selling. And so markets have been, much more on the back foot this week as the move index has moved. Right. And after making a low on Friday, it moved, I think it moved 12 or so points yesterday and the day before, and, probably be up or flattish today. But look into tomorrow's important core PCE. And so that's kind of how things have been. I mean, today's numbers were stale numbers, right? So we are looking at, a worse than expected view of what the first quarter looked like, data through March, and the price index was a tenth lower than what was came out in the initial review. So I think maybe there was some relief about inflation there, which kind of kicked off a bit of bond bullishness in the front end, which led to just broad treasury buying kind of throughout the day, and that elevated small caps, and that was exacerbated by some of the software misses last night, whether it was CRM and some of the others, that kind of led to this little mini, reversal, pain, rotation back. But I think that was just kind of, some position squaring into tomorrow. So tomorrow is important. Even though the number for core PCE is largely known. I don't know exactly the percentages, but at least 3/4 of the numbers are kind of known, because you get the CPI and the PPI are factors that go into core PCE, and the rest of it are kind of assumptions or data that comes in later in the month. And again, we're talking about April here. So the survey, it's just one of those weird situations where the survey is, at 0.25. And, it's kind of ridiculous that we're forecasting or thinking about inflation out to 2 decimals on a monthly basis. But, this is the market that we're in. And so, whether or not this number comes in at 0.25 and rounds to 0.3 versus 0.2499 and rounds to 0.2, for some reason that's going to matter in a big way. And so, the estimates really are running between 0.2 and 0.3. I mean, who knows? I think we'll probably come in, somewhere, very close to that. And I think if we get in the 0.28 to 0.3 camp, markets are going to be very soft tomorrow, because what that'll do is it'll confirm my suspicion that the Fed, needs to continue to remove accommodation in the dot plot. We can talk about the Fed meeting a little bit, but just remove cuts for this year and for next year. And I think as we continue to push cuts out, that's going to be bearish for risk. And on the flip side, if it somehow comes in at 0.23 to 0.2 on the core month on month, folks will say, well, that, keeps a rate cutting cycle on the table. If the data continues to come in that way, there'll be relief that the first quarter of inflation data was an anomaly and that the trend is really back to what we saw in the second half of last year. And that opens up the possibility that the Fed, could be cutting, probably not in July, but maybe in September or maybe in November and certainly by December. And so that would lead to, a risk on event. And so for tomorrow. So a little bit of a binary setup on a number that is, very, very small to determine, because we're right in the middle of this 0.2, 0.3 camp at this 0.25 survey. But I think stepping back, as we get the data and as we roll into next week, when we're going to get all the payroll data, we're going to get the PMI data. I think what we're going to see is a economy in May that was fine. I think the PMIs are going to look okay, because the PMIs are often highly correlated to how well the stock market has done, and the stock market's been fine in the month of May. And so I think we're going to see a recovery in services, PMIs, and ISM. And I think we're going to see a labor market data next week that broadly is, showing no real signs of deterioration. And so I think the setup into the June Fed meeting, which happens on the 12th, will be one of higher yields, higher dollar, and probably a continuation of some of this risk-off behavior that I think we've already kind of started to see to start this week. That's kind of how I'm thinking about it.
All right. So I'm getting a question here regarding Dell kind of bringing things down toward the end, and it kind of carries on a point I want to make, which is, let me show this chart real quick. All right. So basically Dell's dragging SPY lower. You can see that. This is pre-market over here, and we're down about the 147 area. So this is an AI name. It's in the NVIDIA AI ecosystem, and they were massively selling calls right before this big surge day before yesterday. And then today, obviously, it petered out and we had some bearish activity, which was more call selling. And then the results come in, we're down here. We're through this level from basically 2 weeks ago, and we're heading down into this kind of 136 area is most likely. So this is the space that has been leading, so that, the 6 stocks in SPY have made up all of the year-to-date gains, for example, and small caps are only up, 0.5%. Many are kind of pointing to rates as an impact on the interest rate sensitive sectors and stocks, but it's really just the AI ecosystem has been pulling up SPY and NASDAQ. So it really is one sector. Every other sector has been lagging in the past 2 weeks in particular. And now this rotation that has picked up, Dell is definitely kind of a extended play, but we had already IGV, which is software services. And of course, SaaS is leading this descent lower. You can see what happened with CRM, right? That actually happened to be an active play with Workday, also tanking prior with now today's, sell-off. So it's more than just distributive selling, forced selling from, earnings, or just valuations aren't keeping up with the corporate profitability look. And overall, this is the sector rotation that's going on underneath the surface, while VIX is still very, wrong one, very subdued in the 14 handle. So we did come down to that kind of 1181 and pop up, but there really isn't a lot of momentum in volatility because there is selling in other sectors, not yet in semis, which is one of the questions in there. Semis are still, I'm doing this again, get it typed right. Semis are just extremely elevated and coming back down because why? We have NVIDIA, which it makes up 26% of the weighting in SMH, whereas Microsoft is heavily weighted in IGV, and then you also have CRM and Workday and others, and now. So SaaS right now is the target. I think next is going to be hack, or basically cyber plays. So we got to be really on point here that some of this sector rotation in tech is taking place while the leadership in tech AI is still holding up solely because of NVIDIA. And NVIDIA is down aftermarket because of Dell. So I think there's a little bit more rotation going on than most folks actually maybe pay attention to, because SPY has been hanging out up here until NVIDIA hit on that fateful Thursday. My 53.40 price target for the year got hit also, and then it turned tail very strongly, and it's been in distribution. But the one big thing I wanted to mention was not just the Dell tanking, right, after hours today, and the call selling that was very aggressive going into this print for 2 solid days. But this is actually kind of a call selling indicator that I use, and this has already been showing very strongly that they're selling calls on SPX. They're buying puts for protection because they don't want to be caught, flat-footed when that April drawdown came in very aggressively in 3 weeks and took semis down aggressively with it. So I think this is really a liquidity thing. We have still support. There's not a macro trigger, but they are definitely selling calls against the market right now, individual stocks and SPX overall.
Yeah. Look, we talked about maybe on this call 2 weeks ago, just how, when we got past May expiry and past the VIX expiry, which was last Wednesday, that the window of potential weakness was open, and that certain macro catalysts could matter more, and if that started to take hold, the markets could find themselves under some pressure. We also know that systematic buying has been through the roof. Systematic positioning is basically back to nearly the highs. I mean, CTAs are very long, vol control funds are long. Basically, everybody's long.
CTAs are at 100th percentile again.
Right.
They were in April as well.
So look, I think the setup for this window after expiry and after making a high on Friday was that if things went a certain way and bonds started to sell off, and what I had been saying is I really needed to see rate volatility move back up, and that was a precondition for equities to start to stall out. And so we started to get that this week, this combination of the inflation data, the overseas selling, the JGB moves,
JGB
and the like. So look, I think tomorrow is it's an important data point, because if the number comes in hotter than expected tomorrow, what I think is going to wind up happening is we're going to start to see more beta selling in stocks, and we're going to see we're not going to see rotation. We're just going to see outright selling, and I think that's going to continue for tomorrow and into next week, because it will be this reality of economy, okay, but Fed's not going to be providing liquidity yet. some of the earnings are starting to get hit in some of the better sectors. And higher for longer rate environment is not particularly good for, as I've been pointing out, for small caps and for cyclicals. And so, where is the strength going to come from? I'm not sure what the leadership sector, easily will be. I mean, we'll probably just get some more defensive rotations, but I think in light of the market cap, composition in these indexes, I think we could start to see some more selling pick up, and we may start to see, an environment that looks a little bit like last September, where bonds were selling off, stocks were selling off into a Fed meeting with a lot of treasury supply, where the Fed was likely to be hawkish while growth was starting to stall out. I think that's a very possible scenario here as we push through into the June meeting and to June expiry. We also have, fairly significant liquidity drain that's going to come in the middle of June from, corporate tax payments that get done on June 17th. So, Yellen has already run down the TGA quite aggressively over the course of the last few weeks, just given the way that bill's issuance has gone down. That's going to stop. So we're going to get kind of TGA drain. The RRP is likely to be stable, and so bank reserves are going to be getting hit over the course of the remainder of June, and we see this a lot, right? Because these quarterly the way that quarters go and the way the RRP gets built into quarter end and how banks do window dressing. A lot of the big moves lower in markets over the course of the last couple of years have been in the third month of the quarter. Junes and Septembers have been kind of the more, and March for that matter, have been the more suspect times, where again, when things line up and you get liquidity drain and you get macro data going the wrong direction, you can wind up finding yourself in a bit of forced selling type situation. So look, it's the inflation data is still very important. We get a big reading tomorrow, and we'll get prices paid on ISM and services ISM next week. And I think that could push us into an adversarial or an adverse situation for risk into the Fed meeting and into expiry. Unfortunately, this time around, the June CPI is on the morning of the Fed meeting.
June 12th.
It kind of complicates, the setups a little bit. I mean, the Fed will have the data, obviously, at the meeting. In theory, they're supposed to do their dot plot on the Friday, submit their dot plot on the Friday before the meeting, but I think they're allowed to amend it based on the data. So I suspect whatever data we get, on that morning of the Fed is going to matter. So it kind of argues for watching and seeing what happens with that data point, but into that Fed meeting. So we'll talk about that next week or whatever. But again, I think the momentum is one of higher yields, likely higher dollar, economy fine but slowing, Fed not being able to provide any accommodation, and I think for me that's a dicey setup for risk. And to see futures now below 5250, we're in negative gamma regime. With CTAs very long, with all control funds very long, tomorrow could get spicy if that number comes in hot.
So I had this on because I wanted to ask you about it, but why do you say this is stale data? In other words, I just highlighted
because it's from the first quarter. So we already know. We already know that tomorrow's data is April data, so it's more important. I mean, now it's the end of May, right? So we're getting a read on what the data looked like at the end of March. Like, no, who cares, right? I mean, it's not really.
But that wasn't. I guess I understand.
That's what I meant by stale.
All right, you're looking for the next trend quarter. What I was trying to point out was just that in green, you can kind of see the things that are still moving higher previous to act.
Yeah, look, for
are
sure.
growing in prices, 1.7 to 3.
No, look, I mean, people
and
were
the stuff
excited.
that's falling is definitely spending and sales, and it's interesting.
It's very stagflationary data. I mean, people were excited because the forecast at 3.7 versus the actual at 3.6, right, for core PCE prices.
Oh, okay.
But they failed to look at the going from the fourth quarter at 2 to first quarter at 3.6. I mean, this is a massive. It's a massive acceleration of pricing data in the first quarter of the year.
But everything
So
that's decelerating has to do with spending and
right.
economic growth
Yeah.
figures, and trade balance got hit too. Anyway, the point is, I just wanted to say, I understand stale. We're going forward
Yeah.
too, but so far this is still very stag inflationary. So that's all I
Yeah,
wanted to.
and for me, the reason that's important is because the Fed's, in my view, the Fed's reaction function is different in a high inflationary environment that we exist in versus a low inflationary environment, which we existed in kind of prior to COVID for 15 years. And so, folks think that at the first sign of growth deceleration, the Fed is going to provide more stimulus. And with inflation sticky and possibly reaccelerating, I just think that the bar for them to do that is high. Now, when there's treasury market dysfunction, like there was last March with SVB, or last fall with the bond market really selling off, then yeah, if the Fed does kind of get involved, and often elevates the primacy of that smooth market functioning mandate that they have. But with the move index as low as it is right now, and treasury market not showing any signs of strain, I just don't think that there's a worry right now from the Fed on the treasury market. So they have to kind of resort to, well, where are we on inflation? And inflation's running too high, so we're not going to be giving any accommodation. And I think that's been the message from the speakers for the most part over the course of the last few weeks. I would have liked to have heard more about, the potential for a rate hike. They seem to not want to be delivering, that message at all, which I think is foolish, because I think it's making their job even harder, because people still believe that because the next move is cut, that we're just eventually going to cut. So just kind of keep front running that. So I think introducing hike risk could tighten financial conditions and make their job easier of bringing inflation down, but it would lead to a risk asset price correction. They seem that they don't want to trigger that. But I think the June meeting and the dot plot is going to signal something that looks more like a very flat yield curve, a flatter yield curve in the front, where I think they're going to take the median dot probably down, median dot for 2024 for cuts from 3 to 1. Because it doesn't take a lot of movement of the members to move down to 1 cut. And then I think for 2025, I suspect instead of having the additional 4 cuts, I think maybe they'll go to 3 cuts. And I'd like for them to go to 2 or even lower, but they probably won't. And I think there's a chance that they'll see more momentum on bringing up the neutral rate. And so those are the types of things that the Fed could do to try to help tighten financial conditions and slow down any reacceleration of inflation. And if they don't, then it's the same kind of story, right? Powell gets up there, speaks dovishly, and markets go crazy and react positively. But I think between now and then, the more likely scenario is that it's yields up, risk off.
All right, let's talk about this chart. And again, we're taking questions, so hit us up in Zoom Q&A if you have anything you want to hit us with. But this is something that we have gone over as well and updated. If I can find the bloody share screen. Yeah, okay. This 2 and 10 year. So we had done a really good job of kind of rolling down. This is the yield curve spread, by the way, on a weekly and on a daily. For those who are looking, we kind of update this every few weeks, or talk about it anyway. We did an excellent job of breaking the inner wedge, breaking the outer wedge, 11 trading days of basically, bear flattener. And then in a New York minute, it turned tail. And in 2 days, undid 2 weeks and went straight up bull steepener. So what happened? What was the data Tuesday, Wednesday that caused this 100% reversal?
Yeah.
Any ideas?
I think it was driven by the back selling, and it was driven by supply and driven by foreign
A lot of supply
and foreign, and what's happening in foreign duration, particularly JGBs, and also boons. Just more selling out the curve on supply, I think is why we basically really bear steepened that. Look, that chart it's like the chart you just had up is still kind of this chart of truth. And yes, it did break down from the wedge, but now we're back inside. I mean, I think the market hasn't really necessarily figured out yet, like, is Fed policy tight enough to bring inflation down, or is it too loose such that inflation is going to reaccelerate. Like, I think we keep kind of going back and forth on that. And then you have to kind of factor in this supply dynamic, which just sits in the back, and it's like a drip, drip, drip every week, more supply, more supply. So just kind of continues to pressure all yields because of the supply. So yeah, we saw a firm breakdown there that was driven by, some, last week, and I guess just some thoughts about maybe some of the data slowing, and then bang this week because of supply and because of Japan, we're right back into the wedge. So it's not really, again, I don't think we know yet. I think it's still kind of TBD.
Okay. Let's talk about Japan then. This is dollar yen on a daily. This is the JGB 10-year yield on a daily. We have this has been one that we've been, if 80, then 100, in other words, 1%. We're already above 1%. And then just today did an about face, otherwise known as a bearish engulfing. But basically, this is now pausing. It's still very, very firm. Dollar yen and their 10 yield, the whole complex is kind of pulling up our yields as well.
Yeah, I think Japan, is in a tough situation. Economy slowing, very levered, debt to GDP ratios, and so they can't really allow for the bond market to sell off materially and see much higher yields. I think they're going to fight against that, but they also don't want to see the yen weaken too aggressively and too quickly. So I think there's a bit of a game being played back and forth, a little bit of yen weakness, then a little bit of yield up, and then laying back and forth. And so, look, I think the big question for them is how, are they going to wind up selling dollar assets and treasuries in order to defend the currency, or are they not? And I think that we just, we don't really know what happened when they came to America and spoke to Biden and Yellen, and what kind of deal or not was agreed to upon. But broadly speaking, look, I think when JGB yields move up like this, it does put some pressure on the U.S. yield structure, and how much is the Fed and Treasury going to like, a 10-year that moves up another 30, 40 basis points, or the entirety of the yield curve. So Japan does have some ability to pressure the U.S. into, doing what Japan wants, whatever that may be. I mean, Japan still has a massive positive net international investment position. So they have a lot of overseas assets, which they could sell in order to kind of slow down any pace of decline in their bond market or in their currency market. I've surmised, I think that they want to start being able to purchase commodities, especially oil in yen. I think that to be helpful as a tool, but it's not clear that that's happening. But look, I think that Japan is still going to be pressured, but I think more likely outcome is just going to be dollar strength against the yen, from here to, for a long time. And so, anytime we get, those moves, and they check back, we can buy back in on those trades.
So I'm putting up all dollar, US dollar, Taiwan dollar in regards to, there has been some escalation as it relates to geopolitics, but I'm really not talking to timing of that. But this particular kind of manifestation of this carry trade is definitely percolating higher. Any thoughts on this also as it relates to kind of FX, Asia currency, FX moves relative to the dollar? Because we just talked about Japan, who's competing really aggressively with China right now. Taiwan, any comments on that?
Yeah, I mean, there was a lot of saber rattling last week, last weekend, and a lot of activity in the South China Sea, and China moving ships around and doing military exercises. And man, I don't know. I think the way that dollar CNH is traded, and the way that dollar Taiwan is trading, suggests some people, and volatility started to pick up in dollar CNH. So maybe, some people think that there's, reason to hedge. It's very, very tough to gauge kind of, if and when they would do something on Taiwan. I mean, I suspect a blockade is more likely than, outright attack, but I have, no real ability to, to judge that. But look, I think broadly speaking, what you're seeing is, Asian currency weakness, and Japan competes with Taiwan, competes with China, competes with Korea. And so if there's pressure on the yen for a variety of reasons, well, China's not going to want to, fall too far behind from a competitive point of view. And so they allow kind of gradual devaluation of the RMB against the dollar, as long as it remains stable against gold. And then Korea is going to want to do the same thing, and Taiwan's going to want to do the same thing. And so there's definitely, some pressure where if dollar yen continues to strengthen, these other countries are going to feel like they need to, they need to keep up and allow for their currencies to decline as well. So, but look, as the U.S. growth is still relatively best in the world, and the yield structure in the U.S. is still higher than the rest of the world, we're going to continue to have capital flow into dollars and see dollar strength. So
Relatively.
yeah, exactly. So, and
But-
the ECB meets next week, and they're likely to. It seems like a rate cut is a done deal, and that figures to be dollar bullish as well. So we could be in that.
And yet the
dollar
Dixie
reckoning.
itself looks very weak to me. I actually think
Yeah.
this is much bigger weakness relative, I know, to hard assets, and it might be strong relative to the other pair.
Yeah, I've been surprised
talking
by the
about.
euro. I've been surprised by the euro. The
This one
euro
looks weak
strength
to me.
Yeah, the euro strength has definitely surprised me. If they're going to commence a rate cutting cycle, I would have thought it would have been weaker, but the growth data, I guess, has been improving, and oil and energy haven't really run away, so that's helpful for Europe. If oil were to start going and energy were to start going, and I saw there was a headline at the end of the day about Biden has given Ukraine permission to strike inside Russia using U.S. weapons. So that's been a red line for Russia. So I mean, who knows, right? I mean, like, is the geopolitical stuff gonna pick up? And these are things that sit out there. And look, that makes it very difficult to have a trend view, and it also makes it difficult to not have hedges on it over weekends, because this elevated geopolitical risk is still front and center.
So I was asked about the sectors that definitely, I tweeted, and I can't find it right off the hand, but basically tech has been leading. We know that, but it's very specifically AI tech. So lots and lots under the surface from just across the board is softening or falling. For example, the SaaS companies that we can kind of see careening over. Lots of weakness from Palo Alto and now, and CRM, Salesforce. But big picture, semis are still holding up the market as far as leadership. And I think that's what you were referring to in the question about semis. So let me just kind of show this to you. Okay, all other sectors, by the way, are lagging the past few weeks, but semis and tech AI. So you can see kind of relative on a monthly. Until this turns down, I don't know if 5340 is really going to be the top for the year. That was my bet in January, right? So it's technically driven, by the way. We tagged it, in time for NVIDIA, actually right on NVIDIA the day of. So now we've had that kind of buy the rumor, sell the news, both SPX 5340 and the NVIDIA earnings. Now I would expect some weakness, but I don't know if we're going to get back above that. If we do, it's very bullish. But for right now, we have, as Craig's describing, this treasury liquidity keeps coming in. The Fed put the Yellen Yahtzee. They are in cahoots to make sure that we don't have a drama event into the election. Otherwise, we trigger, recession risk, and that gets pulled forward. So until the semis really soften, the AI tech of NVIDIA cohort really start to soften, we can have a lot of distribution in lots of other sectors before volatility reprices everything. So that's one of the things that I'm definitely looking at. What are you looking at for sector rotation? Because I know you do your own style of heat map, and we've talked about that as well. What's really very oversold or very overbought right now in your heat map?
Yeah, I mean, still have utilities actually, more overbought than not, up in like the 96th percentile. I mean, clearly they benefited from both, a defensive rotation and AI, right? I mean, so, utilities have become kind of closet AI plays. Gold and silver miners are still, still looking pretty elevated. I had mentioned in the chat, and I put this trade on last week. FXI had been up in the 99th percentile. So I had shorted some of that and EEM as well. So that still is elevated. But really nothing is screaming kind of, bright red right now. And on the flip
Okay.
side, on the green, I mean, transports are oversold. Brazil's a little bit oversold. But again, nothing really crazy.
Okay.
So
I have, where is this? All right, so let me just kind of show this. If we do get some market correction of size, and I'll show you the sectors that I still really like utilities, by the way, no question about it. But this is SPX. I know it's kind of messy, but we tagged that 53.41.88 on NVIDIA day before we turned tail very, very sharply. And we've been in distribution and lower. If and when we continue to get selling and or volatility, there are lots of gaps to fill on the way down to that November, not only the April, low before we had the reflexive bounce and then a very, very strong May, but we have a lot of gaps all the way down to that November 1st Fed pause and Yellen Yahtzee. No kidding. It's crazy, but I don't go that far. I just want first and foremost to see if my thesis proves correct that 53.40 is in fact, very, very strong resistance. And then I kind of play it level by level after that. And I looked at sector rotation themes to see if they're working or not working. And one thing that's working still extremely well, gold miners. Gold and silver miners are still doing phenomenally. This was actually a chart that I just updated for clients today, last night, that I had posted originally March 10th. So after gold started spiking higher March 1st, I went to all my geeky kind of intermarket analysis tools to see if miners were going to get a bid, and they have continued to stay bid. In fact, I updated all of that last night. So they have been really, really firm. And I would still say my favorite chart, bullish chart, is this gold silver ratio, which just looks still stunning. So utilities I like for sure. That's still long in the swing long portfolio, but the gold, silver, and miners, both industrial and precious, they're still doing really well. So I wouldn't take those off, even though I think the dollar can kind of help support that. But I don't have anything right now that is extended that I like you do. Like I don't see utilities as extended as you do, but I definitely see semis as extremely extended. So that's what I'm looking for. Long story short, is for that turn in this ratio. All right. So we got a few questions. Let's just see.
I just want to interject real quick here. There's a headline, and this could be potentially be market moving, but apparently the Trump jury has reached a verdict. So look, I have no idea what's going to happen with this case at all.
34 counts, I think.
But,
something's going to stick.
Look, the truth of the matter is, if the market would move, I think if he's found guilty, and faces jail time, and I think
It'd be house arrest. Let's be honest. He's got a security detail. It'd be really, really tough.
But how does he run for president when he's under house arrest? I think the market might care. So it's more of just it's a flag here, because I don't think anybody believes that he's not going to be running, and many people believe, and the market believes he's going to be the president again. I think the market has been trading kind of with that bias, and I think if you were to see him behind bars or see him not able to run, it would be very difficult for Republicans to figure out who to replace him, and that could run against Biden. And then we're talking about a Biden administration for 4 more years, which I don't think the market is going to like. Even though the deficits are large, Biden's talking about corporate tax hikes and other things which are anti-business. So I think, while I do believe it's too early to trade the election, this is the type of thing, no one's hedged for this. If Trump is found guilty, potentially there's
no one's actually anticipating RFK either as a viable candidate, because it's a long shot, but it's actually growing. So anyway, not a political statement. Pippa Malbrook has followed this extremely well, and 50% of all new voter registrations are independent and favoring RFK. Granted, who comes out and actually shows up at the polls is another matter. But the point is, there's definitely a disruption to the two-party system potential. We're not there yet, but it's definitely going to be a very interesting run into the election no question about it.
Yeah.
Okay, so question here from Peter. Let's see. You see more and more stocks breaking down decisively from what appears higher magnitude tops. Just talked about that. Last year, growth data comps are very high, very true. And NVIDIA too. Like, is it as good as it gets? That is going to be slowing, which, by the way, that's probably part of the Dell sell-off right now is this the rate of growth is decelerating. So we got to kind of reprice for that. Based on that, by your estimation, have you seen the high for the year? I already said that. So I already think that's the high. I'm good with that. 53.40, I think that's the high. But I actually saw that in January. Now I need to be disproved. All right. What's in chat? I haven't looked here. You want to deep dive on the VIX? And then, of course, China. I think China done going down for this cycle. But I've been really focused on that since January, way early. But I think it's going to be a slugfest. And I think it's going to be months and months of drama. And many still think it's uninvestable with good reason. So these are more kind of swing trades or chases. For example, Craig Bott puts on FXI. It was way extended. So this is for the active trader and or investor, not to, but I know a lot of active investors who think the bottom is firmly in for BABA and some very select China plays. And that's a domain we kind of deal with in the service and place those trades based on fundamental and macro and technical. So I personally don't think China is done going up. I do think it's done going down. Energy is a backdoor AI play given the enormous appetite of data centers. That's another area I've written about and posted a lot. And I am very blessed that we've got clients that trade oil specifically, for example, contributors that trade oil specifically or contributors and clients that are in this space, the energy space, data center AI, how they're locating closer to the source, both solar, nat gas, and this uranium. And uranium. And yeah, this is extremely right now, short term, they've fueled investor appetite for the potential future of this explosion. And there will be pockets, obviously, of pullback. And that's what I think we need to kind of navigate next. I think the run-up is very extended. And now we have to kind of test. Are those sustainable? Some will honestly just be bought because they're touching on the AI theme, and others have to really prove it. So would you share, Craig, your thoughts on gold and yields? We know there have been many BRIC meetings recently. What are your short-term views on gold and silver?
Yeah, I mean, look, gold is, for me, it's remained structural long. Gold's becoming, an increased part of global central bank reserves. Government reserves. Actually, New York Fed had a paper out today, which kind of even talks about how more countries are shifting from treasuries to gold, which I thought was interesting. And it's yes, it's a handful of countries, but it's China, it's Russia, it's big countries. So it's the Middle East. So look, I think as the government deficits in the U.S. are accelerating and showing no signs of stopping, and the government also is threatening sanctions on enemies, it just becomes harder to convince foreigners to buy and hold treasuries. So I think gold becomes more of a part of the reserve system and as a neutral settlement asset over time. So I'm bullish. I think look, when yields rise and aggressively and real rates rise, sure, there's pullback opportunities in gold, but I think these are all kind of viable dips. So what I do is, look, when it looks like it gets overbought, sell some calls or, whatever, just kind of stay long, but protect and just keep kind of grinding the trade, riding the trade higher. I think gold's going to, be 3,000 probably by the end of the year and just continue to move higher. Silver is less of a focus for me. It's more of an industrial metal. Obviously there's, a lot of folks who believe in, silver squeezes and shortages and, silver's a meme and other stuff, but I don't know. I mean, I see it as an industrial metal and, when growth is good, I think you want to own gold, we want to own silver because, supply demand is probably improving and growth is decelerating and you don't want to own as much silver. So silver got to the 99.99th percentile last week. So, I bought some puts for like a day or two just because you just stay out, just to like with lunch money. So that's what you got to do. But I think the trend for all commodities, structurally is going to be higher over time, but just, we have to ride those waves. As far as yields, as I've been saying, I think we're going to keep seeing yields move higher, on back of a Fed that's going to be tighter for longer, and on back of all this incremental treasury supply. So I still see higher yield environment. I don't really see any reason to own the long end of the US or really any sovereign curve. It's shocking to me how low yields are for 10s and for 30s. Still, I would never buy bonds there. If you want yield, you could just keep buying 3-month T-bills at 5.4% or whatever, the 5.3%, whatever the numbers are, and keep rolling those, because there's no real risk of a Fed emergency rate cut that's going to take you out of those T-bills and not allow you to reinvest them at something very attractive. So I still like that. I'm looking here in the chat. Any thoughts on palladium? I'm not really, look, I mean, it's much more of a, again, industrial metal, very European, I'm sorry, very China auto driven in a lot of ways. It kind of fits in the commodity, thematic over time, better supply demand, pricing away from dollars, more emerging market demand, but no real axe there. And then on small caps, I'm short small caps. I'm pretty well public about how I think small caps are the most exposed to higher rates. They're most exposed to slowdown in the economy, less pricing power, labor inflation, energy inflation hits them, and they're going to have significant refi risk. Obviously, there's pockets or names within small caps if you get in the weeds and can really find winners, sure. But I think thematically and as an asset class and as an index, I still think that you're going to see underperformance.
I have posted charts for clients on palladium and platinum, and really they're slow movers. There's just so much more great fishing inside gold and silver miners. Just really excited much more about that. If you're speaking in general, because of a macro backdrop, it's so slow moving. But as it relates to PAL or the minor SBSW, I'm not quite sure if you're kind of specifically referring to any of those, but it's just not as interesting as gold and silver to me personally. And I've tracked them for years. They just really haven't gone anywhere fast. So I like the yield softness right now, believe it or not, call that I had for a warm summer housing market hasn't materialized yet. We're still kind of chopping about in that 4.5 level. But I can see us actually heading down to 4.2 this summer in the 10-year. I know that shocks a lot of folks, but that's still my baseline bet. And I can see us getting above my 4.688, which is a very specific technical level. That once we get above, we're going to shoot back up to 5.3. Once we get above 5.3, we're going to head to 6.5. So that's a call that I made last year into the end of the year. So I don't see it as during the summer, unless we get some, macro, market moving event to get us there, and the carry trade unwind slowly, then all at once for the yen could be it. But I don't have a timing tool for that. But I could definitely see that yields are very, very prices are sticky, yields are sticky, but I think this summer they could come in, they meaning intervention with facilities like second home mortgages. We talked about this with, in our Edge webinar last week for clients, as it relates to also move. Right now, we still have that 30-year at that 7% level, but you get move softening and you get the 30-year softening. Anyway, the point is I can still see a low of 4.2% in the 10-year, but once we get and stay above, let's call it 4.7, it's very, very bullish. But that right now is strong resistance. So doesn't mean, we can't have a dance in between, and lots of narratives will come and go. We'll look and see what the SEP is for the FOMC meeting to see if they really are pulling out those cuts like Craig expects from 3 to 1, for example, for 2024. But for right now, I don't see any real reason to get excited about spiking higher yields until the end of the year. That's my baseline bet. So I can actually see a case for a bond bounce this summer. Maybe it's recession risk. Maybe it's, an equity sell-off. Maybe it's just yield softening. And that's very, very viable. But big picture, I'm still a big bond bear. I just don't see the 10-year getting above that 4.7 and sticking that landing until the end of the year. What about the small caps for you? I know they're your whack-a-mole. You keep
that's what I was.
shorting them.
Yeah, I keep shorting them. I keep thinking that this is still the place you could be underweight. I just don't see an economy that's going to reaccelerate, and I don't see a Fed that's going to be providing liquidity quickly. So days like today are annoying, but I think you gotta keep kind of selling into any strength there.
So days like today, I've got a good chart for that because let me just bring this up in a second. That's the right one. All right, so I've got a chart I want to show that kind of focuses on that rotation. So Craig is really, really good. He's got his kind of longer duration macro trades, and then he manifests a lot of short duration chases, what I call chases anyway, for a few days. And right now we're clearly, you can't really tell without knowing what this is. It's a growth value rotation chart, and it shows that obviously growth, which has been really in play, by the way, over value since May 1st, is petering out, right? CRM, Microsoft, doesn't matter. Tech right now got hit, Dell after hours, NVIDIA after hours. But the point is tech is coming down, and that means Russell tends to get the rotation of money, right? They go out of tech, they go into Russell, they go out of banks, they go into NASDAQ, they go out of NASDAQ, they go into banks. This is sector rotation. Money keeps moving. So it's just one way to kind of time that kind of small cap rotation, or how I use it with clients is this is a good time to get puts on Qs because growth is coming back in, and sure enough, it's rolling over. So, but generally speaking, small cap Russell's been going nowhere fast, right? I mean, we are flat year to date, and it is just not interested in really reacting. Why? Whether it's yields are firm, many 40% are zombies, or it just doesn't have a lot of the AI plays. The only one that's in the Russell 2000 is SMCI. Otherwise, the big mega cap AI tech is all SPY, and it's obviously outperforming for that reason. So any other thoughts about kind of event risk coming up, Craig? We've got, as you mentioned, FOMC on the 12th, and the CPI same day, PCE this Friday. Any thoughts on how the dollar or yields would are going to react? We already see the selling after our hours with Dell, and today that could continue. But big picture, are you looking at any particular moves in bonds and fixed income for tomorrow's PCE?
Well, look, tomorrow's PCE is going to be important. Tonight, actually, we also get China PMI, and then tomorrow, we get Chicago PMI, regional PMI. But look, next week is labor data week. Next week is data week, right? I mean, the first week of every month is, we get the first look at how the prior month went. And so we'll get the ISM, and we get services ISM, we get ADP, we get payrolls on Friday, unit labor costs, kind of the whole shebang. So look, I think an environment where economy is continuing to show strength, even if it's decelerating, is not an economy that the Fed is going to be quick to give accommodation. And so if that's the type of data that we get next week, we're going to get bond yields to move higher, we're going to get dollar to move higher, and I think that is going to be more risk off type behavior for stocks. Again, certain stocks do well, certain, but I think it's, will be bad for small caps. And look, my view continues to be that this economy, this market needs and wants liquidity at all times. And when it feels like it's getting it, or it's about to get it, or it's going to get the timeline to getting it is sooner, risk does well. And when that timeline gets pushed out, risk does poorly. This economy doesn't necessarily, or this market doesn't stand on its own. It needs that liquidity all the time. And so, there is no rotation to, well, the Fed can, slow down a combination and the economy is just going to grow on its own and earnings are going to grow on its own. This is not how it's not how it works. It's not how the market works. And so market is incessant in its desire for liquidity. And so if the data comes in, we're going to be we could be in a situation, I think, where good is bad, right? Good data is bad for risk because it will confirm this higher for longer setup, and stocks look ahead. And so stocks are going to start seeing a 2-year yield at north of 5%, and they're going to see no rate cuts potentially for all of 2024. Then they're going to start to say, oh crap, what does that do for 2025 earnings? That it's more of a headwind. These companies that have to refi later this year are going to be struggling. Consumers are going to be struggling. Housing's not going to pick back. So that'll be the narrative that picks up. That's why good is bad on the data, coming in next week. And really, there's no real early indicators that the data for May has been poor. There's been some strong credit card data, even amidst all the consumer issues. It seems like retail prints over the course of the last couple of weeks have been mixed. Some have been very good, some have been very bad. It just kind of depends on, if you're in the right segment or if you're in the right part of the economy. But the consumer seems like it's, broadly consumers are strained, but they're not really slowing down materially. So again, I think this is an economy that is okay, slowing, but not rapidly. Inflation is sticky, and the Fed needs to intonate that it will be on hold for longer. And I think what they're going to wind up doing is taking the dots to, a very low level of cuts for this year, one, and maybe, for next year, remove some cuts too. And I think people will start to, really start to embrace this idea. Well, damn, like rates are going to be high for long, and we're not going to have an easing cycle coming to us very quickly here, and we got to, hunker down and deal with these higher rates. So I think that's the setup for now into June, with the market that is very long, vol still, fairly compressed, systematic flows are very long. And now that the market is in this negative gamma regime, we could get selling begets more selling if the data starts to come in, as I would expect.
Well, that kind of wraps up the power hour. We got a few other questions, but I think we'll table that for next time, because Marty, the copper electrification and such is definitely an area where Jeffrey spends a lot of time. He's really in the whole EV space. And metals still, to me, are a fabulous continuation trade. I don't see any reason to sell copper here. There's higher to go. Lots of transition going globally in the EV world, and copper is not the only play, by the way. So definitely lots in that space to hold on to. Things over paper. All right, so I just want to also thank you for taking the time to kind of pop in here. We do have a new website, LaDucTrading.com. You want to read more about Craig and others that we've got on the team. This is definitely the place to go, and I appreciate just this time and kind of going through and talking shop about macro and micro, and see where we go into the next 2 weeks. We'll be back on FOMC Day, which is June 12th, Wednesday, for double duty, CPI and Fed.
Nice.
All right. Wish everyone a great afternoon and rest of the weekend. Thank you so much, Craig.
Thanks. Take care. Bye.
Bye. Subscribe to LaDuc Trading YouTube channel for more macro to micro power hour videos and other content.